All right, so good morning, good afternoon, or good evening, wherever you are in the world. This is a market update. It's approximately 1:15 p.m. Eastern Time, 10:15 a.m. Pacific Time. And I'm going to start off with the S&P futures as the market calendar shifts into earnings mode. We've got major earnings for the large caps, especially the FANG stocks. And we want to see if what's going to happen. And it's been a pretty bearish market. However, there are turning points this next month in November that has a high probability, or historically has shown that a rally, a very vicious rally that I think is going to happen after the midterm elections. So midterm elections is a trigger or a significant calendar date where the markets can change regardless of whatever the Fed mandate is. Because I think the Fed mandate, they're targeting 2% inflation. So these mandates, even though they're very strict, I think we're already, with all the interest rate hikes, we're probably well over 40% into their mandate. Maybe even 50 or 60. It's hard to say as the inflation numbers keeps on moving higher or lower. But as the rates keep on increasing, the probability of a pause or a reversal increases, right? And that might something with the midterm elections might influence the whole the Fed's mandate. So we'll see what happens, but historically speaking, the market should start to see bullishness coming into the first week of November, and then we've got huge tax loss selling from November into December with the Christmas rally and then the January effect. So that rally alone could produce about 20 to 30% in about 3 to 4 months. And right now I'm looking at the S&P futures, and if you take a look at the short-term chart on a macro scale from COVID lows to where we are right now, and just use like a Fibonacci retracement from the lows to the highs, we actually can see that we're at the tap that 50% Fibonacci retracement, which is quite significant. And I think because the S&P is pulling back the way it is right now from the top, right? 52-week highs. When you get introduced to 52-week highs, that opens the opportunity of 52-week lows. From 52-week lows, that introduces opportunities for 52-week highs. And now we pulled back 50%, right? So now the bulls and the bears are probably, they're going to create their own thesis. And yes, the golden ratio at 61.8 is definitely a target for the S&P. And that would, I think, even on the media, the media gurus, they're calling for like a 20% pullback, right? And yeah, if that's 16% pullback, that's going to be obviously really nasty. However, that 50% retracement is showing, actually the way it bounced off the 50% retracement shows real strong conviction that the bulls are in control. If the bears were in control, then it wouldn't. I mean, you probably, like, if you turn on the Heikin-Ashi candle and look at the centroid status, it does look like the bulls are trying to take over this zone, right, between the 38 to 50. So it's obviously in this very difficult consolidation range, and it's been very choppy, especially this candle right here, where you can see it's just gone back and forth. Now, if the S&P continues to move higher and front runs the midterm elections, then the next target is going to be the the 50-day moving average. Now, that 50-day moving average is still under the 200. So there's nothing really to be bullish about long term until it gets up there. But if you're conservative, right, which is a trader that's looking for like 5-10% per year, then you're gonna look for confirmation when the S&P gets above the 200-day moving average, which is from the 52-week high, gives you still a pretty good return. Let's say if it gets above here and breaks out, yeah, you're still getting around 15% for holding a position for the next 3 to 4 months, right? Now, if you're an aggressive investor, you would try to buy low as possible and then look for a 52 high, which would give you another additional 50%, making it a net of 30%, right? Or gross. So that's where we are right now. And if the market decides to roll over from the 50, because if you're going to short, you don't want to short where it's at the lows. You want to short where it gets a big spike. Then that would probably be either the 50 or the 200. And there's no way of knowing. But right now, when I look at the TTM squeeze, this thing looks like it's going to probably break out through the 50. That's 3,764. So if it gets there and it decides to go roll over because of, like inflation rates increasing from 75 basis points to 100, whatever it is, right? Then a good short would be at the 50, and that gives you 18%, right? So you're at the 50-50 mark, right? The 50% retracement mark, where you get 15% return from where we are right now, or if you decide to short here, which is a little bit tough, then you're getting, still like 14%. So 14% down, so 15% upside target, and you got, if you take a long position here and you're going up to the 200, then you got 11%. If you take a long position here and hold into January effect, that gives you 30%. If you decide to short here, because you think the market is still bearish, then you get 14, or I think probably up to 18% if you short from the, what's going on here? Let's see if I can adjust this properly. So the 50-day moving average down to the 61.8 gives you 20%. Okay, and if you go long here into January, then you got 30%. Okay, so that's January to make a new 52-week high, which is around 27%, or even higher. Right, a new 52-week high would probably take it to near 30%. Okay, so yeah, this is, if you look at this looks like a catching a falling knife. So this is probably day traders heaven, but especially for the bearish day traders. And now, looking like there is a bounce off that 50% retracement. The question is it going to go down lower or is it going to go higher? So right now, short-term wise, it's probably going to look like it's going to move higher to the 50-day moving average. It seems that the ASICs has some sort of news associated with it. I'm not sure. It is in the short-term micro time frames, like the lower time frames, like the 5. You can actually see that the daily candle is relative to the closing price is quite it's above the 6-day moving average, right? And on Friday morning, it looked like it was going to roll over and crash, and it didn't, because obviously you can see the MACD is on the upside, positive 0, above this slow moving average, slow MACD. And then when it opened on Friday, it pulled back. However, the techs were already running higher. And then we got like I think it was looking for 2 to 3, even 4% move in the S&P. However, there was no news, and the S&P settled for 2.41%. Now, going into Sunday, when the market opens, I suspect if you look at the daily moving average it's 3,680, and then so it's a $15 rise. So from here you get three. If it's like say if it goes up to 3,000, the next 6-day moving average goes up to 3,710, for example. That is where the Sunday futures might pull back. Okay, so there might be a little bit of a pullback on Sunday and today, and if it does pull back to 3,110, that would be a 1.4% drop, okay, on Sunday futures. My best guess is it goes down to around 0.4.5. That's probably the average I've been seeing in the futures. And then if it just hangs out there for long enough, then it'll bring up the 6-day moving average, the next 6-day moving average, probably close to 3,725, right? Because the moving average is bringing up the number. So then if that happens and the price of the futures start to push through the previous day close, 3,764, then you got two things that can happen, are likely to happen. It's going to run up and then close as a doji, or run up and just tag that 50-day moving average, which is a 3.46% move, and that's based on no news. So if there's no news, then it's not going to go straight to 3.46 in one day. That would be pretty crazy. It is possible, but probability-wise, 3.46 days in the S&P futures usually happens on economic, geopolitical type of news. If there's none of that, then you're getting, you're getting 2.5% max, and then if there's no news, and then that's what you're going to have to settle with 2.5 as its max. So the mean on 2.5 would be 1.25 is where you would want to start to look to take profits off the table. But keep in mind that daily candle here is a BLT setup. So the probability of two large green candles consecutively is a lot lower than having a doji, where like it moves up high enough and makes a full robust green candle and then it pulls back. That's more likely than getting a full green candle. This one, when it was pulling back on Wednesdays are pretty, not the best. Wednesdays and Thursdays pulled back, and then Friday, when it pulled back a little bit more, it short squeezed, because the past Fridays, like the past 4 Fridays, have been very, very bearish. So bears got caught, bulls took over, and then now you're looking to see if we get this flat daily candle that pushes fast and then pulls back at the end of the day, forming a doji. And then on Tuesday we get I think there's significant earnings that's going to probably pop it up to 3,893. So earnings is the key here I think, because I don't see. Let's just take a look at the economic calendar. Oh yeah, I think there are some economic news coming out on that consumer confidence index. Okay, so Friday we got CPI. So Friday is going to be a binary event where prices can move higher and lower end. And if it does, so this is pretty straightforward, because you have two moving averages, 50 and 200, and wherever the price of the S&P is on Thursday, 30 minutes before the close, if it's up against a major moving average, I don't think it's going to get to the 200. I don't think it's going to make a 10% move in 4 days, right? But what it can do is it can run up about 1% per day, right? So 1% per day. So that's about up to Thursday. We can probably see a total move of around 3.4. So on Thursday, if the S&P is right at that 50-day moving average before the bell rings, like 5 minutes before the bell rings, then you have a binary event on Friday, CPI, which is going to introduce either a breakout above 3,892 or a breakdown, which will obviously introduce more bearish sentiment into the market. So Friday is going to be a pretty crazy day for all those options because of the CPI. And you won't know how the CPI is going to, what kind of numbers are coming out, right? Because that's all, I mean, I can only imagine if it's being reported by a human, then the probability of it being manipulated is huge, right? We don't know what the ethics and of the committee is and how they're managing all these data numbers coming out to be released, but because we don't know, we'll call it obviously binary, and that I think putting on a put and a call on either side is worth a shot because of the exponential nature of the returns that the SPX produces. Okay, so this A6 here, if I turn on the Heikin-Ashi candle on the S&P, is also showing like a high compression squeeze setup here. So that is massive. And if it does break out, then it's going to break out in a very, very big way. And this TTM squeeze can last around 14 days. So 14 days, let's say that this is, right, that can produce about 7 to 14%. So if we look at where we are right now, and we take a 7% move from here, that would take us very close to the 200-day moving average. Okay, and that's my assumption going into the earnings. The market has been completely decimated with all these growth stocks down more than 70-80%, and it's been a pretty tough year. However, the year is not over yet, and that midterm elections is a huge trigger point. So I would say that remaining bullish, okay, for now, is the best side to be on. And then if things do get extended, you probably can look for a scalp with some puts. But you're not gonna. I don't think it's a good time to go aggressive on the short side, since there is this TTM squeeze, which is going to. I mean, if the market is super bearish, still, and we get that short squeeze, this short squeeze, especially this A6, the last one produced a pretty strong. It's like not the strongest rally, but this one, because we're going into earnings. And midterm elections, this could actually, this is the attempt where the S&P tries to break out above that 200-day moving average, just like Netflix did. So if you take a look at Netflix, Netflix is like being killed, and it just moved right above the 200-day moving average, and that's a bullish sign for tech. Okay, so if Netflix is moving up, because Netflix is super intense. In the amount of money that it needs to borrow, and if interest rates keep on moving higher, then it's going to affect the revenue for Netflix and the bottom line. But if there is a group, if there's any sense of the interest rates pausing and then pivoting, I don't know. I don't think there's ever going to be a pivot until who knows when. But a pause is definitely probable, right? Because of how aggressive the rates have gone up so much. Then that pause is being kind of interpreted in the Netflix stock price. Okay, and but Netflix is going to have a bit of a so you can see the A6 is 1, 2, 3, and then on the fourth, I think I'm still looking for that launch pad to pull back to the 6-day moving average. I don't think it's just going to go straight up to the stratosphere yet. It's going to pull back and tag that 6-day moving average. So that would be at around, I would say, if that was 450 to 457. So around $8 from 458. So from 258. So that'd be 266. So let's say 267. So I think right around here, 269, 267. That's where the next 6-day moving average is going to form. And the price of Netflix will start to slowly pull back, because it's not going to, I don't think it's going to keep on moving higher, because now the money from earnings has exhausted, right? And a lot of the money will be thinking, okay, we've gone up like 20% in 3 days. That's a lot. And it's going to consolidate, right, to decide whether the price should move higher or lower. And it's going to consolidate not only because it's gone up so much, but we got the big boys, Apple, Amazon, Google, that are stepping up the plate. So money is going to be moving around away or still in Netflix, giving it time to consolidate and pull back for that launch pad. So the launch pad will basically means that little pop right here will form a doji and then pull back 3 or 4 days down to the 6-day moving average. It doesn't necessarily mean that the 267, 270 is where the launch pad takes place. It could take place right around 280 to 270, wherever the next 3-4 days takes that 6-day moving average. Then if that's the funny thing here is that with the CPI data coming out on Friday and the launch pad pulling back, you can see clearly that if the launch pad doesn't work, then it's going to fill the gap at 250, which is still bullish after it fills, right? Depends on how it closes, but that is a possibility where Netflix could pull back on Friday, like when the CPI report is released. So that's something to keep in mind. You don't want to be buying here at 290. It could tap 300 on Monday and Tuesday and then pull back to fill that gap on Friday, CPI dependent. Nvidia here. So Nvidia is also showing that TTM squeeze, and there's a gap. There's this magic Mike pull that can probably get a little bit more price action to the upside with a double top at 127.67, and then Tuesday you get the gap fill. Now I don't think it's going to fill the rest of the gap here, but there's earnings in November with CPI in between, and then after CPI you got midterm elections. So any pullback to the 6-day moving average, long-term wise, Nvidia is a good buying opportunity. Okay, so you can see the 6-day moving average, the green dots are increasing with a positive slope, and then any price that pulls back, for example like this, gets another pop the next day. Okay, so it's very choppy. So this is a good day trading stock, especially between Thursday and Tuesday. And any pullback to the 6-day moving average, I think that's an opportunity to buy literally 5 minutes before the closing bell. So Amazon has earnings, and it's pushed right through the 21-day moving average. With earnings, right, you never know with how each of the earnings are going to perform, whether it's going to go up 20% or down percent. Nobody will know, right? But here it does look like Amazon is picking up and ready to break out, and the problem is we don't know the magnitude of the move, and it does look like it has a lot of gaps to the upside. So if we are going to run up in January, it's better that these earnings remain flat, right? Because we don't want any more gaps being introduced or gapping over a gap and then have more gaps to worry about. But there's a lot of gaps open, right? And all the bears are thinking that the gaps can fill all the way down to 10 to 11. That's not going to happen unless unless there's a World War III that breaks out. I closed Boeing. I have Tesla position, so let's take a look at Tesla. I closed off my Boeing. It could move higher, but you can see here with Tesla, it had a pretty nasty earnings. I actually bought some shares for my daughter on Tesla on this day here, right? But and it dropped down 7% and went up like 4% from that. But that's my newborn daughter, so it's 18 years, and I guess in theory, when you have a newborn baby, the first thing you want to do is get those numbers running, the government documents where they can be eligible to be taxed, social insurance number, so that you can buy some strong, some popular strong growth companies like Tesla or maybe even Apple, right? And then buy it at time equals 0, like basically when the baby's born. And then you just put in like $1,000, $2,500. And here in Canada, they give you, government gives subsidizes adds maybe another $500 for every $2,500 that you contribute, right? So I'll just be buying this for my daughter, Tesla, Google, maybe even Netflix, and just build it over time for the next 5 to 8 years, and then maybe manage it after the 12th year, because I think I don't know. I think just leave it till she's 18. That's when she'll be able to actually use those funds for her education, right? So when you're born, like if you think about it, if you were born and your father and your parents have access to the market, and if you have experience with trading in the market, that time is super important. But for a newborn, time is kind of like a luxury. And if you buy, they're not going to be, the newborn babies are not going to be trading stocks, but they can definitely be a Warren Buffett, approach the market in a Warren Buffett way by buying when there's fear and selling when there's greed, right? And that there's no better time to do that when the newborn baby is born on time equals 0, because that's just, everything else is like premium that they can afford. And plus, I mean, when does a newborn baby start working and make $2,500 as soon as they're born, right? Only the parents could contribute to that. So with that $2,500 plus the government support subsidizing every $500 for every $2,500 for every year for the next, I don't know how many years, like 18 years, then it's like a no-brainer, right? And then that pretty much, I think if you just make one investment of $2,500 and just leave it there for the newborn and let it grow for 18 years, I think that's just enough to cover like the whole tuition for university and college. The trick is, the caveat is that your kid has to go to college, right? If they don't, then you lose all that money, I guess. All right, so looking at Tesla, you got that gap here. So Tesla likes to fill gaps, and if the market remains bullish, and we did see that the VIX is now trading under the 26-8 day moving average. The bulls are now firmly in control from what we see on the VIX. The last 3 weeks, the VIX kept on chopping around the 6 and pumping above the 6, and it made the trading environment very difficult, because most of the time we monitor the VIX to see whether people are buying insurance or not buying insurance. This time it does look like no one is really buying insurance, and you're going to probably get a lot of if you're following Twitter or you're following somebody, you're going to get a lot of mixed messages, and you have to kind of you have to kind of understand that, they have their own approach of trading the markets, and so be it, right? If they think that the market is going to keep on moving lower, or if there's some, like a person who's buying $1 million to $4 million put position, a call position on the VIX, you have to really think about, like, what's that intention, right? And from when I see flow, like, I don't really use flow. I get people sending me information about it, but when I look at a lot of these flows, you don't get baby fed trades with those flow mechanisms, right? Those things are pretty damn scary, like, from a analytical perspective. You can kind of monitor how flow money is moving in and out of each strike price, but that if it was that easy, then the confidence in each trade where flow is moving faster in one strike than other would be taking your position sizing from 20% up to like 60%. That would be crazy, yeah, especially in a market like this. So my point here is that if you think that the $4 million VIX call position that somebody sent me is real, then you should also put down, a sizable position in the VIX and see what happens. And probably what's going to happen is you're going to lose all your money. So what can you do? Well, you have to understand that the market does not give out freebies, and if they do give out freebies, you're going to have to look for those freebies in the last 30 minutes of the closing day, or the first 15 minutes pre-market, and first 15 minutes after when the post-opening bell. Okay, right after the bell opens, you have 15 minutes to look for those trades that are kind of freebies, because the volatility will create an imbalance in the supply and demand. Price will be affected, and you have to quickly recognize whether that's a trade you want to get into off of a candlestick combination, wolf wave pattern, whatever you're using, or maybe a 78-minute TTM squeeze. But right now we got a daily TTM squeeze in the S&P and probably in the NASDAQ, and that NASDAQ is looking like wants to shift over from the zero histogram to the positive zero histogram. And you can see the next major moving average is 12,000. So this is a pretty straightforward setup in the NASDAQ. And actually, I might even trade the NDX, because SPX are great. I think even NDX offers zero DTE. And the reason why I want to go zero DTE on the NDX is because it has a higher beta, but it looks like actually NASDAQ and the S&P closed off exactly 2.41%. Now earnings could push the NASDAQ higher than 2.41% on Monday or Tuesday, probably Tuesday, because that's when earnings are. And what I think is going to happen is going to get a BLT. So you get a doji, a little bit of a pullback, closes flat or a little bit green, and then you get a big breakout to the 50-day moving average. And let's just see what the magnitude is. Let's say it's here to here. Yeah, so 5.44% between what's not going to happen on Monday, because I'm assuming doji BLT on Monday, but on Tuesday going into Wednesday with a little overshoot, you get that big thick green candle on Tuesday and a little bit of overshoot on Monday, and then probably sell off into the CPI Friday, right? Like not a strong sell-off, but a gradual sell-off into the CPI Friday, and that's going to be a binary event, so I don't know what's going to happen. But right now, for short term, in the next 3 or 4 days, I'm thinking NDX up to almost 12,000, so 11,976. Let's take a look at Apple. So Apple is on the Kikanashi candle is long, and it's been long since October 14th. So it's looking exactly like the S&P and the NASDAQ, looking for a breakout to 1,154. Earnings is October 27th. So that earnings for Apple before CPI I would say they pump it up to the 50-day moving average. It's not too far away from the 200-day moving average, which would be fantastic. You can see the last time it squeezed here on the bearish side, it didn't squeeze too low. There's this bearish squeeze pushed it pretty low. That's a low compression squeeze. This one's a higher compression squeeze, and that's going to probably push it up to 151 to 154. Now I know there's a lot of people who think Apple could go down to like 120 to maybe 130, and yeah, like I mean, I think that's that's possible, but only when the centroid has changed its color from green to red. Okay, it just can't go to 128. So let's just say somebody's saying that Apple is going to drop. Apple's chart looks like crap. Okay, it looks like crap, but if it depends on when you started trading. But if you started trading like back here in 2017, it looks great, right? You're going to buy more. But if you're short term and you got this bearish attitude about the American markets, and you truly believe that everybody who's all those millions of people who are working in these companies are working for no reason, right? I think a lot of, if you worked in a company, people are working hard to secure their retirement, right? Because they get paid discounted shares, maybe like 10-15% off, and they're accumulating, especially in those companies that have a very good reputation like Apple. So if you think these people are like going to get rug pulled and have Apple drop down to 120, then yeah, I mean, that's going to be unfortunate for those people, but they're going to still keep buying, right, at a discount. But what if it doesn't, right? What if it just keeps on moving higher? Well, then you want to know if you're on the right side on the short term, and that's basically looking at the Heikin-Ashi candle. That gives you this position of the centroid, and that's bullish for now. The only time that that Apple could drop from now till earnings would be on earnings, right? When it rises this much and it transitions from green to red, okay, there's a probability now that the bears are in control. It could pull all the way back to some sort of major support level. Now, when it's green and your centroid is green and you're moving into earnings, then you have no reason to be short Apple thinking it's going to drop down to 120, because the momentum is on the side of the bulls, not on the bears. Going into a binary event, because we don't know what the hell is happening with the fundamentals and the accounting in Apple, then that is the time where it could gap down 10%. But even with a 10% drop, from on earnings would be just like, yeah, that would a 10% drop would start the sell off and then push it all the way down to like 120. But you don't know when. So the best time, if you're going to go short, and if you believe in someone's analysis thinking that Apple's going to drop down to 127, then you're going to have to figure out like what to do on the binary event, because right now Apple's pretty bullish on the daily time frame. Facebook, yeah, so that's a very interesting stock. I think it's losing its focus in business. They do command like more than, I don't know, 1 billion accounts, right? So they have monetizing power, but their business model has significantly changed and the confidence has gone out the window. So yeah, I don't even know if bad news can even turn into good news in this type of stock. Probably just stay away. Looking at Shopify, it's been also pretty choppy on the monthly time frame. It does look like it's trying to form that bottom. So if it forms that bottom, then a run up to 180 in the next 6 to 12 months is a long-term investment. So picking up some long-term calls that say 2024 for $100, that's not a bad long-term investment on those leaps. Because now it looks like it's bottom, right? The centroid, the momentum, the magnitude, the volume is all in here. And as it moves lower, it's kind of it's decreasing at an exponential rate on a monthly time frame. Now it can easily go down lower on, just like where the monthly doji here formed red. You would maybe on a monthly say time frame, you say, oh, it's red now, let's go bullet bearish. Well, you would probably need confirmation, and that confirmation would be a red candle, but this is a green candle. Now that could happen here. You get a green candle doji, and then you get this massive cascading sell-off down to like $10. That's possible, right? So yeah, is this an investment that you want to do on leaps? Well, I think if you're going to make a decision to do that, you would probably want to do that before earnings, because that's your best shot for like a big return in a short period of time. Snapchat has gone down 28%. So this is something that Shopify could do, right? So if you look at the monthly time frame on Snap, it has that same look, right? And it looks like it's decreasing, the momentum increasing at an exponential rate, and as it starts to reach the end of its run, it starts to decrease. The momentum starts decreasing, and you're looking for that centroid to turn green. But earnings, showed something different, and that's that binary event. So with Shopify, if you want to take that risk, not saying that Snap and Shopify are related. They're totally in a different business. But I think if you're looking for a conservative, you probably want to wait after earnings to get into Shop, or if you want to be aggressive, then you want to do it prior to earnings. Okay, that depends on what kind of outlook you have. And I think Shopify has a pretty good business model. It's just the stock just took a huge hit for I don't know whatever reason it was. Looking at Walmart looks like it's it had that wolf wave target that I was not able to identify on the 4-hour time frame, but it looks like it reached its objective. So short term wise, I think because of the tech earnings, Walmart is going to be a non-event, not a very exciting trade because all the spotlight is on the FANG stocks. Google. So if I go through Google, looks exactly like Apple, Amazon, NASDAQ, S&P. It's going to run up into earnings, and then whatever happened in earnings, yeah, that's a big question. I don't know. All right, so yeah, there's a lot of great trades, but right now, currently, I'm holding on to Tesla, so I'm looking for a gap fill at 228, 220 on Monday into Tuesday. There is that does look like a BLT setup, right? And then it could just shoot up to 217 and then pull back and close as a doji and then move up higher. Not quite sure, but if it does move up to 217, that means it gets above the 8-day moving average and then sets up for a run up to the 21. It tried to do that here on October 18th, but it gapped up at 229 and then gap reversal down to 220, filling that pre-market gap, and then proceeded to move lower into earnings. So we have that same setup where it closed under the 8 and the 6, opens up on Monday flat, okay, with some sort of news. I think there's news being anticipated. And then we get a quick fill of the 217. That's where I'll be closing my positions. And then depending on how significant the news is in the pre-market move, like it could gap up like 5%. There is definitely no, we've seen that before in Tesla. But if it doesn't, it's better that it opens up flat, right? But whatever news comes out at around 8 a.m. before the opening bell is going to determine the magnitude of the move and how much momentum is going to be following through. So if it opens up flat and then news comes out at the bell, then you probably want to hold it all the way up to like 217 and manage risk. If it gaps up at 5, you probably want to take like 80% of the positions off the table, maybe even 90, and then see what happens if there's a gap reversal fill on Monday into Tuesday, which I don't know if it's going to happen until you close the position. You just don't know what your next move is going to be. And if it opens up flat and runs up, then it's the same thing. I'm going to start looking to take 50% and then tranche out of 25% as it fills this 217 gap. I think there's also a lot of other gaps on the short term. So you can even see on the 30-minute time frame, there's a 200 moving average on the 30-minute time frame at 225. So if it pushes through and runs up to that 225, that means it's overshooting this 217, 221, 220 gap, right? And overshoots, then yeah, definitely you don't want to hold anything because it's probably going to consolidate here. You can hold one depending on how many contracts you have. I have about 100. So if you have, say like 10 and you're up here, you want to close probably 9, right? And then you got one, you can always get back at the end of the day to see if it plays out. But on the daily candle, it looks like it's just going to pop and then pull back and form like a doji. And then you got a BLT set up for another pop to make it up to 229, double topping here at 230. That's filling the gap at the next gap here at 230 to really fill it up to 238. News dependent, right? If the news is good, the markets are good, VIX is falling, then you got all these gaps that you're going to try to trade for on Tesla. Okay, thank you very much for your time and enjoy the rest of your day.